Well, the name David Solomon is perhaps most synonymous with Goldman Sachs. Now, if you're not the avid follower of his DJing career as DJ D-Sol, last week the New Yorker ran a somewhat critical article of his tenure so far. Our next guest has written an opposing piece for the Financial Times, arguing that one should not get bogged down by criticism and instead look at the hard data from the bank, which has seen changes and growth under Solomon's leadership. Let's bring in fintech and bank strategic advisor Rupak Ghose. Thank you so much for joining me this morning. So, we did see New York Magazine. They didn't cut any, they weren't very soft in that op-ed title, "Is David Solomon too big a jerk to run Goldman Sachs?" But you're basically saying perhaps they should be focusing on other aspects of the actual business themselves. Break down your base case from your op-ed.
Sure. I think, look, in essence, I think, you can't be a jerk and have bad performance, bad risk management, and bad compliance as CEO of an investment bank. But if you do have good performance, particularly very good performance, I think you can afford to be a jerk of somewhat nature. You can't have compliance breaches, you can't have risk management breaches, but none of the articles that have swirled around the media in the last 12, 18 months have talked about risk management or compliance breaches. And actually, the operational performance of Goldman Sachs has been very good under David Solomon. If you look at the 5 years he's been CEO, the share price is up almost 50%. It's up. That compares with the average bank stock that's down 20%. It's lagged Morgan Stanley. That's the Achilles heel that James Gorman is doing so well. But he's actually outperformed Jamie Dimon. How many CEOs can say they've had a share price that's outperformed Jamie Dimon? And he's outperformed pretty much every major bank CEO in Europe and the US in terms of share price. Why is that? They've had book value growth of 55 to 60% in over 5 years. What is book value? It's essentially the profits that they generated over 5 years. The profits have been very, very strong. Returns have been very strong for the last 5 years. And market share has been very strong in its core business. Market share is really important because the market can go up or down. A lot of retail banks are doing very well in the US because obviously rates have risen. There's a flight to deposits out of Silicon Valley into JP Morgan, into Bank of America, and so forth. But market share, Goldman has been at record levels in its fixed income business, bond trading, commodities, so forth, in equities, where they're very strong with hedge fund client base. So they are, doing very well in their core businesses. Last couple of quarters have been a little bit messy, but that's partly because of the consumer business, where we've obviously had some high-profile issues with performance. They went into consumer. That was actually Lloyd's idea rather than David's idea. And they're unwinding that, and they're coming back closer to home, where they're focusing much more on asset management as a strategic focus. I think if Solomon gets three things right, firstly, gets quarterly earnings motoring again, which is key, I think. Consistently, he was generating mid-teens, double-digit returns on equity the last couple of years. The last couple of quarters have been mixed because of these write-downs in private equity investments, because of the consumer banking unwind and so forth. But if he continues to get the market share in its core businesses and mid-teens returns, I think shareholders will like that. I think the old saying that success has 1,000 fathers and failure has an orphan, I think it applies here. And that consistency with quarterly earnings is important. I think secondly, unforced errors, whether it's going up to Hamilton College and getting misunderstood or speaking out of turn or other things he's done internally and so forth. Again, no compliance breaches and no risk management breaches so far, but generally no unforced errors is, I think, the second thing that's really important. And I think the third thing is a strategic vision. I think the move into consumer was incorrect. Goldman, as sort of barbarians of the gate, thought they could go anywhere, and consumer was an area they failed in. But sticking close at home with asset management, where they have a core DNA in alternatives and hedge funds and private equity, I think is a focus, and really growing that business so they can expand their multiple. The way that we analyze bank stocks is a price to book value, and the price to book value of Morgan Stanley has risen significantly as James Gorman has moved that business out of more volatile investment banking into more recurring wealth management. And Solomon has to achieve that over a number of years.
And so then at the end of the day, does it even matter then when you compare, your Gorman, your Dimon and Solomon together and their leadership styles, if when you actually look at the financial performance, Goldman is still in a very good place? And also, what would the succession plan even look like? Is there even a clear line of succession for David Solomon?
Yeah, I think the performance of the business has been strong under him. They haven't had that strategic expansion they needed to do. But he's had some headwinds in terms of the investment banking business and so forth. And I think if you take Goldman out of the equation, I think he's probably done as well as anyone in the last couple of years. And many of the Gorman decisions were done over a decade. And I think your point about succession is very important. And also, I think we look at CEOs of past and people of the past often through rose-tinted eyes in terms of if you look at the history of his predecessor as CEO, they lost a lot of market share in fixed income post the financial crisis, whereas the Dodd-Frank rules bit. They had some massive scandals with Malaysia in terms of the sovereign wealth fund there and some massive fines. So they've had some issues in the past. Previous Goldman CEOs have had issues, whether it's John Corzine with MF Global or Bob Rubin at Citigroup and so forth. So there isn't an obvious bench here of people. And I think you're showing a chart of partners leaving. The fact is that Goldman partners are phenomenally well paid. That's why they have very strong views and so forth. And they are very well connected, and people want to hire them on the street. But I don't think the turnover at Goldman at senior levels has been materially higher than under previous regimes. I think it's a sort of clickbait that obviously at the moment it's great to highlight those departures. And look, it's not normal to have that many partners speaking out to New York Magazine in that much detail. But I do think there is an issue with succession here. Who would be the obvious successor? Everyone talks about Waldron, but he's close to Solomon. There isn't an obvious successor that people talk about Blankfein coming back. But again, I would question his legacy, whether it's 1MDB in Malaysia, whether it's the FIC market share losses that he had, the strategic vision that he had. There was really limited strategic change under his reign.
And it certainly does seem that, people, at least investors, aren't as worried about how the sausage is being made, and they are focusing on that financial data. A big thank you there to FinTech and Bank Strategic Advisor Rupak Ghose. Really fascinating conversation there. Thank you for your time this morning.
Thank you so much.